And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. Of course, Wednesday as we get into day 3 of the Republican National Convention. Trump has obviously now picked J.D. Vance as his vice presidential candidate, and which is interesting because this is going to be a push. And now we're seeing this already being reflected in the markets. And we're going to talk a little bit more about this today, but we're seeing a push already in the markets to shift from this mega cap concentration that we had back into, we talked a little bit about this on yesterday's Morning Before the Bell episode, the shift into small mid caps, infrastructure, yields dropping on expectations. Yesterday it was interesting because Donald Trump kind of laid out some of his plans for policy. And again, as we talked about before, what's important for the markets is going to be their expectations of policy going forward, right? So once we have the election, whoever gets elected, what policies are they going to be implementing? Of course, Trump focusing on tax cuts, corporate tax cut rate back to 15%, tariffs obviously on imported goods from countries like China. So again, we're already starting to see some impact there for international companies as well, companies that are subject to higher tariffs, underperforming here as of late. Interestingly enough, he talked about letting Jerome Powell finish out his term. Now, Jerome Powell's term ends in 2026. So he's talking about letting him run that out. So again, this kind of immediate idea that he would fire Powell when he comes into office, that's been kind of put to rest right now. Kevin Hassett is likely the lead runner right now to replace Jerome Powell as Fed chairman when that term comes up. One of the more interesting announcements, though, was Jamnie Dimon as Treasury Secretary. Now, Jamnie Dimon, of course, if you don't know, is the head of J.P. Morgan Chase. So very interestingly, to put the fox in the henhouse, say we now take the head of the largest bank in the world right now and put them as the head of the Treasury. What could possibly go wrong with that? I have no idea. But I do have to say, probably a better choice than Janet Yellen at this juncture. So, but I have to wait for and see is can Richard Rosso pull off a Jamie Dimon impersonation? That's going to be the real question. As because on Fridays you get a lot of Janet Yellen, but once she's gone, can he pull off a Jamie Dimon? We'll see.
He'll have to dye his hair.
Exactly. So, but there's some interesting announcements. Now, does any of that actually come to fruition? Who knows, right? Nobody knows. But this is what the markets have been trading on for the last 5 days in particular. And as we discussed yesterday, the Russell 2000 index has had a huge move. It's up 10% in 5 days. The largest move since 1987, which ended with the crash of 1987. I'm not saying that's going to happen again. It's just we haven't had this big of a move in the Russell 2000 since then in 5 days. So it's been pretty large. So outside of that, again, that's what the markets are kind of banking on right now. Now, of course, the Democratic National Convention, they've got to nominate Joe Biden and Kamala Harris right now, and that's the expectation. So again, when we get closer to the election, that's where the risk of a correction in the market comes from, because now we don't know who's going to actually win. Predicted odds right now have Donald Trump winning the presidency by a fairly decent margin. And the markets are and Wall Street's already kind of picking up on that. And that's why you're seeing this rotational trade into those sectors that would be most affected by a Trump presidency. That's the current expectation. But look, we're still a long ways out from the election. A lot can change between now and then. President Biden comes out and does some policy changes, whatever, gets something passed that can shift. And again, those things can happen, and they're called the October surprises. And we've seen this historically in the past, where all of a sudden there's peace in the Middle East, or the Ukraine-Russia war comes to an end and there's a peace agreement made in October right before the election, and that can change the outcome of the election. So that's why there's always a bit of risk going into the actual election. It may seem certain right now that a particular candidate may win, but again, a lot can happen over the next couple of months. So just be a little bit careful with your portfolio, going all in on a Trump trade at the moment, because things can happen, right? And then you can be on the wrong side of the trade. So again, it's very interesting what's going on. Again, lots of announcements coming out today as well. There'll be more headlines today. It's expected that the Democrats will nominate Joe Biden as their candidate by the end of the month. So we'll kind of see how this works out. So here's what you need to know before the bell this morning. Futures are pointing down fairly sharply this morning. Now, I wouldn't read a lot into that, but this market's just kind of been on fire for the last few days. Just kind of keep grinding higher. You're going to have a correction here at some point. So futures pointing down a little bit weaker this morning. Not any real headline data right now to drive that to any great degree. But again, we are fairly deviated above moving averages. As we've talked about before, markets are overbought on multiple levels. So you just need a bit of a pullback here towards that 20-day moving average. So, potentially right now about 55.10 on the S&P 500 is a potential kind of test of that 20-day moving average. So again, maybe a day or two of a correction wouldn't be outside the realm. What we're going to see today in particular is really kind of pressure on the mega caps, right? So the Magnificent Seven in particular, you're going to see some pressure on NVIDIA and AMD and Microsoft and Google today. The Russell small cap will probably continue to get some rotational trade today. It looks to be down right now. No, we're still early, right? It's 6:15 in the morning right now. So, we're still a long way from market open, but right now, futures are pointing lower across most indices. But again, small caps are going to hold up better than large caps today. Again, and that's really kind of been the case over the last couple of days. Even though the S&P continues to kind of grind higher, it's been underperforming relative to small caps. But that's just this kind of underlying transition that's occurring, this rotation in the markets. And we've talked about this for a while, is that we're going to see this rotation. And so we're seeing some rotation out of these Magnificent Seven into areas like utilities and real estate. And that's been pretty much a function of declining yields, which we have seen a fairly sharp decline in yields over the last couple of days in particular. And again, we are establishing a very nice trend now in lower yields. So again, just from a technical perspective on yields, so no matter what your outlook is on interest rates and what you think inflation is going to do, et cetera, the trend of interest rates is now confirming lower. We have a period of lower highs, we have a period of lower lows, and we're continuing to work that. We've broken through all the major moving averages now to the downside. We came up and retested support here recently, or resistance. That resistance held. Now we've moved down, broken through support levels, and we're starting to kind of a base here at new lows. So again, we've seen this before, and again, yields are getting fairly oversold. Now remember, yields are the inverse of price. So if yields are going down, bond prices are going up, but yields are getting fairly oversold right now, which is overbought on the bond price side. So things are getting a little bit overbought. So expect to see, again, probably another period where we see rates come up here a little bit. Keep working in this trend of just that kind of this grind lower in yields as we start moving towards that first Fed rate cut in September. So again, it's not going to go straight down. It's going to be a bounce, but we're trending in the right direction for lower yields, and that's going to be supportive for areas like utilities, real estate, interest rate sensitive sectors of the markets. That's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff, and talk about the sexy trade. I don't know what that is, but we'll talk about it. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me this morning as well. We got to talk about a few things. You know, I'm getting really upset about people complaining about stuff. Right? I mean, they're whining about $2.50 for iced tea, $3.50 for coffee, $5 for parking. If they keep complaining, I'm gonna stop inviting people to sleep over. So,
you running an Air BNB now?
I got to pay the bills, man.
All right, I hear you.
It's getting expensive.
Inflation's real.
So yeah, so this whole hurricane barrel thing has really thrown a wrench into things. So you know, we came back and we were talking about on the show, Danny, that you know, have you got your power back yet?
We did, thankfully.
Yeah, so
thankfully.
We got ours back on Saturday. We got home on Friday. Didn't have power. We got it back on Saturday.
You've had a number of string of things. Thank goodness you were out of town, right?
Exactly. And you know, we talked about before, normally when I leave town, the market crashes. So, but this time it was a hurricane. And so just beware when I leave town, crap happens.
Not anymore. Hey, you've bucked that trend.
Exactly. So, but, you know, we were trying to move at the end of the month, and our lease is running out on our rent. So we rented a property a couple of years ago when we sold our house, and we've been remodeling a house for about a year now. And we're just in the final throes of that, just down to that last little leg, right? And so everything's been timed so that we could move out of our rental when our rent was up and move into my wife's house. Yes, it's her house. It's not my house. It's her house. Let's be clear about this.
You have a room,
It is.
right?
I have a room that I rent with my monthly paycheck. But anyway, because all the power was out, right, nobody could work. So we're now 2 weeks behind on getting everything done. So we're having to renegotiate with our landlord to let us stay one more month. So
I'm living that dream right now.
It's terrible, isn't it?
Yeah, moved back in last month from the flood we had.
Yeah.
And last month, at the end of this last month. And not done either. And, you know.
Yeah.
Not
are you back into your house now?
We are in.
So you're living in a construction zone?
Pretty much.
Yeah.
We're 95% of the way done.
Yeah.
But yeah.
That's what we're trying to avoid, is moving in and then having to live in a construction zone. So
I thought that's what we were going to be avoid. They promised we'd be done by May. I was like, we'll give ourselves a little bit of a buffer. And nope.
It's very convenient that they just have to have a hurricane that threw them off. But yeah, anyway, it's all good. So Danny, a couple of things to get into this morning. You got an interesting headline called "Beware the Sexy Trade as the Economy Slows Down." One of our we've interviewed people from Double Line before. One of the Jeffrey Sherman, we've actually interviewed on the show a while back. We did a podcast with him talking about credit and a lot of other things going on, but really, really smart guy. And he was talking about, he's the deputy chief investment officer at DoubleLine. So if you're not familiar with DoubleLine, they're probably one of the world's largest bond funds. Jeffrey Gundlach is the head of that and the face, obviously. Jeffrey Sermon works there as well. Again, just a whole shop of very brilliant people that work there. But he had some really interesting comments talking about, this Magnificent Seven and kind of, beware of this potential trade because we've had so much money flowing into this one group of stocks that it certainly seems like it should be a risk, right, Danny?
Yeah, I think it is a significant risk. I mean, we've talked about this just from a market cap perspective on how large these companies have become and the overall impact they have, especially when you look at just a sheer size, when you think about portfolio sizing and looking at the broad index as a whole. I mean, if you look at that Mag 7, you're at 35%, give or take, of the whole broad market as the S&P 500. You look at NASDAQ, it's quite a bit more. So this can be problematic. It's great on the way up if you are invested in those funds. And so what the fear is, and I think we've talked to a lot of people, Lance, who have more recently been a little bit more on the other side where they're more conservative. And by nature, by what we do, we're more of a buy, hold, monitor, sell. People historically come to us because they want somebody who can mitigate risk but still participate on the upside. And so we don't get as much of that, I think, as probably as many, right? They want to just chase, but it's still there. And I think it's natural that when we see something that's gone up as much as it has, historically, human nature, we want to jump in. We do the opposite of what Warren Buffett has always said, buy low, sell high, the old really fundamental adage. And we have a tendency to jump into things as they're continuing to rise. Now, the problem is that how far can they go? We've talked about how we've really quickly forgotten how bad NVIDIA did back in 2022. Now, granted, this has been a meteoric run, right? There's no doubt about it. Right. It's tough not to want to be there. And certainly, look, we own NVIDIA in our portfolio. Now, we do take profits periodically.
Which we did yesterday.
Yep, correct. And so I think that's the important aspect of this. So don't get caught up in this big, sexy trade. And what I see a lot of times, Lance, is that somebody's getting near retirement and they think, I am not where I need to be. And so we start looking ahead and saying, how can I go ahead and kind of supercharge this at the end? And sometimes it's not with savings because we don't have the ability to save additional funds. So instead, they try to make it up with, returns in the market, which is great. So what I would, kind of challenge everybody to think about is that if this is you and you're trying to put funds aside and you're looking for how do I make additional returns just prior to retirement, think about the risk of loss as well. So we talk about disciplines and having guardrails on a regular basis. And I think that's really important to understand what's your exit strategy if you're going to get a little bit more aggressive. We talked a couple weeks ago about, concentrated portfolio risk. And I think that is really prevalent right now if we're going to go all in these areas. And, just since Thursday, we're beginning to see a sector rotation. Okay. So we're seeing more of that value play, which I think has been pushed off. You look at RSP, equally weighted S&P 500 ETF, it gained like 3.5% just while everything else has kind of faltered a little bit. Yeah. So we've seen that where maybe funds are flowing. I think our concern has been, we've seen this before, kind of like with small caps, right?
Right.
And then all of a sudden you don't get the legs that you hope. So if we're looking at how do we invest in something like NVIDIA or any of these companies that may be that quote unquote sexy trade, I think we need to understand the risk that is there and what happens. Okay, so if you make 10, 15, 20%, hey, maybe a lot more. I don't know. This thing continues to run.
Yeah.
What's the impact? Is it significant? Is it life-changing? But what if you lose 20, 30, 40%? What does that do to your overall portfolio? What does it do to your retirement plan? And this is where I think that, we go back, and you hear me talk about this often, is that we need to go back to the plan. What is the overall, can you withstand a bigger drawdown? And that's what I fear when people start getting a little bit, over their skis and take on too much risk in an environment like this, that inevitably we see that pullback. They get caught in the middle of it. They get in too late. They get out at the wrong time. Right. And, that can pose a really big problem for a financial plan.
Well, that's something we talked about the other day is, the biggest challenge with investing is doing what's the most uncomfortable thing.
Yeah.
Buying when everything seems overvalued, it's interesting. Lieutenant Dan in our chat just made a comment. It's like hard for me to buy anything with the Buffett indicator where it is. Yeah, stocks are very overvalued. Terrible short-term indicator though, right? What valuations tell you is what returns should be over the next decade. But in the midst of that next decade where returns are going to be low, you're going to have some fantastic years of 10, 15, 20% gains. Yeah, you're going to have a drawdown in there somewhere, 20, 25, 30%, maybe 2. And that can certainly happen. And then you look back over 10 years and go, yeah, my returns were very low. That's what the Buffett Indicator tells you. It's a terrible device for managing short-term risk in your portfolio, man. And this is the hard part about investing is, fighting those emotional biases. When markets are selling off, you just immediately assume they're going to keep selling off, so you don't want to buy anything. And then when markets are going up, you don't want to buy anything because they're too high, and they may correct, but you're in the middle of a bullish trend, and markets are going to kind of continue to grind higher. And so this just drags you into doing all these, emotionally bad, so I shouldn't say emotionally, but, psychologically driven mistakes that keep us from, making money and doing those things. And the other side of this, Danny, is also just like you're talking about, we have this tendency to want to trade what's hot. And this is why, like, if you take a look at our portfolio, we've always maintained a balance between, tech stocks, and we own Microsoft and Google and Amazon and NVIDIA in our portfolio. But we also own a bunch of really boring companies. We own Berkshire Hathaway, Visa, these other companies like that have not really been in favor this year. They've really kind of drug on the portfolio a bit this year relative to the other stocks that are in there. But now that this rotation's occurring, the portfolio's buffered against that decline because it's picking up these rotational flows that's moving from these large caps into mid caps. And so we just simply go in, and as we did yesterday, we trimmed off NVIDIA, we trimmed off AMD, move those back to target as we talk about, taking profits, move those back to target weights, and we're allowing those value stocks to now come back into play and to buffer the portfolio while we go through this rotation.
Yeah, and I think the other aspect of this as well is that, we trade based on, short-term trends, and what we're looking at, from is what most people are looking at. That sexy trade's easy to get caught up in, but, that rotation's important. But then we also trade, a lot of people will, on what they think the economy should be or will be, right? And sometimes that doesn't come to fruition for quite some time. And so that, Jeffrey Sherman does mention there's a conundrum. We have a mixed bag. You got retail sales being revised, job numbers are a lot more part-time jobs and full-time employment. So we're seeing, weekly hours decline. There are problems that we see with this overall. Then we talk about the big-time indicators that we've talked about for 2 years now. Yeah. Inverted yield curve, the leading economic index, all these things that historically point to a recession. And then you just mentioned PEs. That's really difficult too, because that is a very poor short-term indicator, and the markets can remain, in this type of state longer than most people can remain rational. And that's where I think we need to, probably just exercise a little bit of caution in this, in that, yes, we are seeing the economy slow down. Does that mean we're going into recession? Not necessarily, but we're seeing things change.
Yep.
And we need to be nimble and flexible with our portfolio and how we invest, what we do. Don't get caught up. Don't put everything in one spot, in the sense that you just can't get out there and expect to invest in one or two companies and, be extremely successful, unless that's all you do. Right?
Yep. It's all about having an edge.
Correct.
As Gordon Gekko says. All right, quick break. We'll come back. I did want to touch real quick on that retail sales number yesterday. It's getting a lot of headline news this morning. We'll talk a little bit about that. We've also got some other stuff to get into with Danny as well. So don't go away. More of The Real Investment Show coming right up.
Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Today is a very sad day because we had a very serious set of deaths in our house.
The Real Investment Show podcast.
It's been just a very traumatic few days. We lost our new coffee maker, we lost our air fryer, and we lost our oven when this power surge came through the house.
Same show, your schedule.
That's how big the surge was coming through the house, but I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but
at realinvestmentadvice.com.
I'm a little cranky.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I want to talk a little bit about retail sales here real quick because that was a report out yesterday that was kind of moving the market. But before we get there real quick, Danny, I thought this was, funny because, I was on Twitter the other day and in the mornings I post. If you don't follow us on Twitter, go to @LanceRoberts on X/Twitter. I don't know what to call it anymore. Just that thing with the blue bird. Now it's an X. So go there.
Well, Elon Musk actually just put a poll out saying, should he go back to Twitter or keep it X?
Yes, he should go back to Twitter.
You think?
Yeah. He's also just said he is now moving SpaceX and X/Twitter to Texas. So he's moving it all to Texas. Anyway.
Remember, you're not missionaries, you're refugees.
Oh, he's
Oh, I'm not talking about him.
Yeah.
I'm talking about everybody that works for him.
Exactly. But anyway, yesterday, our good friend Cathie Woods, who runs ARK Investments, she put out a tweet, and I thought you'd appreciate this as a financial planner. You deal a lot with this, right?
Yep.
She said, as a result, I guess of their trading and performance, our trading-related capital tax losses should offset trading-related capital tax gains for years, an underappreciated asset associated with our strategies.
So, okay.
So do I need to read that again, or did you understand what she
just said? No, I understood it, but you may want to read it again for everybody else out there.
As a result, our trading-related capital tax losses should offset trading-related capital tax gains for years. It's an underappreciated asset associated with our strategies.
Well, I agree it's an underappreciated asset, right? I do think a lot of planners do utilize this, but... I mean, that's a problem, right? How big are the losses we're talking about? And I know what she's referring to. She's referring back to 2022, right? And so where tech got beat up. I mean, and listen.
Her performance, she's been massively underperforming markets for 3 years now.
Yeah, and she's historically beat them. You got to think, though, she's on the types of companies that she invests in, right? She does invest in some of the big boys, but a lot of those are startups. They require, cheap capital. So higher interest rates do impact those companies. But, being in that tech space, and, here's one thing I think that we give a lot of people way too much grief for. If she has a tech fund, she has to remain invested in tech regardless of the environment, right?
Sure.
So if that's what she has to do, I get it. Now, her being actively trading does help in that aspect, that instead of just being a broad index, not doing anything, she can do some of that tax loss harvesting, take those losses.
And we do the same thing.
Yeah, of course, but not to that magnitude.
So this is my point. The way she words this, and if you listen to how she worded this, what she's saying is that we've had tremendous losses, but hey, that's actually an asset for you. The fact that we lost money is actually good for you because now we have an asset. And if these stocks ever come back into favor, you'll have an asset.
Well, she sold them to
gains.
realize those losses.
Yeah, exactly.
But here's the deal. You need to own those individual stocks, not just, that's where it becomes a problem.
Yeah, and this is the problem with, both mutual funds as well as ETFs, is that, with your ETF goes up and down in value, and she'll recognize tax benefits on her side, but you don't necessarily get the pass through of all that through an ETF into your portfolio.
Or
right?
with a fund, you could be liable for capital gains.
That's correct.
You see the capital gain distributions at the end of the year.
We've seen that before, where the market's down for the year, and then all of a sudden you get a capital gains tax bill, from the mutual fund.
Well, that's a really good point. I think that's why, I think you and John talked a little bit about cost yesterday with owning different types of investments. And that is, I think, part of the criteria if you're looking at where do you put funds. And we can make an argument for a mutual fund. We don't use them often, but it's likely for us going to have to be somebody that provides a niche, something that maybe we're not, we don't have the boots on the ground to do something, right? Think small cap, internationally emerging markets, something crazy that is going to, or somebody just provides a ton of additional value, because that's going to be additional cost for our clients. Now, an ETF, though, or an individual stock, we can do that much easier, and there's not a lot of inherent fees associated with that. So that's where a benefit is if you're thinking of that. But then that tax loss harvesting is effectively what she's talking about, is something that you can utilize. And we do look for that each and every year. There's years where you don't have many opportunities. I remember back in 21, I think we could sell one position, right?
But let me do say one thing, is that our investment strategy is not based around creating capital losses.
No. Well, I don't think hers is either.
Well, that's what she said, though. She said this is part of our strategy.
She was a wordsmith with that one. I wonder who wrote that for her. It took her a long time to think of that. Let me see. How can I put this?
Exactly. All right, look, let's talk a little about retail sales. Dear friend of mine, David Rosenberg, put out a great tweet yesterday. If you saw that retail sales report, it came in basically flat. And of course, there were a lot of immediate excuses around this, which was actually the retail consumer was a lot stronger, because this was all an anomaly due to a hack on used car dealers where it impacted sales for the month, and so they couldn't transact used car sales because of this hack that occurred. And that impacted retail sales. But if you strip that out, the core retail sales were actually good. The problem, as is always the case, and particularly as of late, and Danny just mentioned this in passing, is that we keep having these negative revisions to prior data. But Dave Rosenberg put out a really good point. I'm just going to read to you this quote from him. So if you were rubbing your eyes, as I was, over that retail sales report, I think I found the answer. There was a very generous, in quotes, seasonal adjustment factor at play, the raw NSA. So NSA is non-seasonally adjusted. So, if you don't understand what happens with economic data, let's say that, I poll the three of us in here and I say, okay, what did you buy last month? And Brent tells me what he bought. Danny tells me what he bought. I tell you what I bought. We put all this together. So that's the non-seasonally adjusted, right? That's just the raw data. We all didn't buy anything last month, right? But then we look at what the government does and say, well, there's some things that occur in July or June. This was June data. So in June, these certain things occur. And so we're going to add some sales in there because it may not have been captured by the data. So we seasonally adjust these things to smooth out volatility changes in market environments, et cetera. It's kind of a lot of fuzzy math. Not sure how it all works, but this is what happens. So they take the non-seasonally adjusted data, that's the raw survey, and then they put these adjustments in to compensate for, changes in the economy. So back to what he said, the raw NSA data actually showed retail sales down 5.6% month over month in June. That is a very large drop in retail sales data, which actually is more in line with what we're seeing with a lot of the other economic data that's coming across, whether it's been employment as of late creeping up above 4.1%. We're seeing a lot of other impacts and some of the other hard and soft economic data, leading economic indicators, et cetera. ISM services dropping into negative territory. So that negative 5.6% month over month rate for retail sales is probably a better indicator of what's going on. He continues, this is the worst drubbing in a decade and tied for the steepest plunge since the series began in 1992. So take that retail sales report yesterday with a little bit of grain of salt. It was actually probably a lot weaker than expected. And what I suspect is that next month, when we get the retail sales report, we'll see a negative revision to the June report as well. So just something to kind of think about.
Well, and how many reports have now been revised down?
A lot of them.
Yeah.
And here's the problem. So right now we've had this really massive jump into small cap stocks over the last 5 days. We've had the biggest increase in small cap stocks, Russell 2000 in particular, since 1987, right before the crash occurred. Now, that's not saying that's going to happen again, but everybody's jumping into the small cap rotational trade. The problem is, and I'm writing an article on this for Tuesday, is that 40% of these companies in the Russell 2000 are non-profitable. They have a very big debt problem coming up next year where they've got to refinance a lot of their debt, particularly at higher rates, because the rates won't come down fast enough for them to refinance at basically zero where they were financing before. So there's a big debt wall coming up next year they've got to deal with. But most importantly, two other factors. These companies do not have the ability to do stock buybacks to the degree that large cap companies do. A lot of the ability for companies like Apple and Google and Nvidia, et cetera, to beat earnings has been a function of share buybacks where they can lower the value of the number of shares outstanding, so it's easier for that EPS number to continue to grow. Small cap, mid cap companies don't have that kind of capital, particularly if they're non-profitable, right? The other side of this, and there's really, I said two factors, but three factors. The other issue is for these companies is they are very subject to economic changes. Small cap and mid cap companies are very dependent on the economy. And so one reason they tend to run with changes in interest rates are going up. They tend to underperform because interest rates are getting tighter. People aren't spending as much, et cetera. Interest rates come down. Theoretically, people have more money to spend, so they tend to do better. But if the economy slows down, their earnings are going to be impacted, and all of a sudden, valuations become an issue for small and mid-cap companies. And then lastly, they don't have the benefit. If you take a look at the S&P 500, 35% of the S&P 500 is 10 stocks. So every dollar that goes into a passive ETF, like the S&P 500 ETF, SPY, 35 cents of that dollar goes into 10 stocks. The Russell 2000 is very equally weighted. About all of them run between 0.3 and 0.5% of that index. So they don't get the dispersion of flows of every dollar invested into the index. So the passive ETF flows don't impact those companies to the same degree as it happens in large cap. So be careful chasing this right now. Not saying that it can't go on, not saying that we can't see this rotation last a while longer. We certainly can. But there are some fundamental issues that may creep up on these companies over the course of the next few months.
Well, in short term, isn't this based on Powell's comments on interest rates potentially being lower quicker? But they won't go low enough, quick enough for them to make...
That's the issue.
Yeah.
We'll talk some more about this, wrap up the show when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny joining me as well, so always happy to have you here. T1 in our chat asked a really good question. This is something that we deal with a good bit in terms of just our own portfolio management, and I think it's just a kind of a good primer as what's going on. T1, can you put in the chat what stock you're talking about in particular? His comment was that his struggle is when to sell a technically sound stock that's like a good blue chip company. So, we can just kind of go through a chart real quick and look at that just from, kind of how to manage a technical position in a portfolio. So if you'll put the stock in there, we can actually do that. If I'll give you a second. If not, then I'll just pick one and we'll do it. But this is a challenge that, we all deal with, and Danny does when, he's talking to clients. And we just had this issue recently with Stanley Black & Decker. And this is, it was very interesting. The stock's been under pressure earlier this year. We own it. It's fundamentally a very sound company. We like the company for a variety of reasons. It has a very nice yield, about 4%. So a lot of reasons to want on the stock, but it was underperforming while the rest of the stock market was just going up, right? So it was, every day NVIDIA's up, AMD's up, et cetera. We got this one kind of dog sitting over here not doing anything. And the issue becomes then now all of a sudden the small cap rotation. And again, this is what we talked about earlier, is that we have these stocks in our portfolio that are the value trade. So we have this growth component of the portfolio and we have a value trade part of our portfolio. Our dividend equity model is also built the same way. It has a weighting in the big mega cap stocks to generate performance, and it has a bunch of stocks to generate income and value. So that's kind of how we build that metric. And well, over the last few days, everybody's complaining about Stanley Black & Decker 2 weeks ago. Now they love it, right? So, this is always the challenge with investing. But there does come a time where, you've got a stock and it's been underperforming, as a good example, and now it's had some performance. So when do you sell it, right? Or is this the rotation where this is all kind of new thing? Brent, can you bring up my chart for me real quick? I'm just gonna T1 didn't give me the stock, so shame on you. I'm going to use AT&T as an example because telecommunications have been out of favor for quite some time. AT&T has really kind of been a poster child, but again, a fundamentally very sound company, and currently has a dividend of about 6%. Was closer to 7% previously, and but it's not been in the kind of position where this was just going up. And so you've got the stock position. Oh, sorry, Brent, I didn't mean to do that to you. Let me remove that. Bear with me. I messed up. I hit the wrong button for Brent. I apologize. There you go, Brent. Sorry. Didn't mean to do that to you. But this is a stock that has lately, and again, when we take a look at it, really since November, has been moving higher with the overall market. Now, it's not up relative to what the overall market is, right? So compared to the S&P 500, it's been really underperforming, but it's had a nice return since really kind of November. But if we go back further and we just move to a weekly chart, we can kind of see the dynamic of what's been going on. And the stock has had repeated rallies that fail, right? And so this has been a very challenging stock to own. It's like, wow, I really like this company fundamentally. We've owned it previously. We've sold it. We bought it back. We've sold it again. But this has been the challenge. Well, so right now, technically, the stock is very stretched, right? We've had a very big run since really September of last year. It's very stretched technically. This is a weekly chart, mind you. So we're talking about 2 standard deviation extension above the 50-week moving average. So this is almost a 1-year moving average. It's very, very stretched from that standpoint. So again, you've had a great run out of this stock. And so this would be the point, not to sell it entirely, right? But this is where you start going, hey, you know what? I need to take some profits out of this. And, we could see a nice retracement in AT&T back towards that 16.5 level where that kind of that 50-week moving average is. That should be decent support, but that has failed repeatedly. This stock has been trading between the upper deviation and the lower deviation consistently, really going back to 2021. And again, when we take a look at a longer term chart, so this is now a monthly chart, you can really see the dynamic of how poorly this stock has been performing really over the last, really since 2016. And this has been a big underperformer. Yes, it pays a dividend. A lot of people own the company because of the dividend. Yeah, I don't care what the price does because it just yields a dividend, but you're down substantially in that capital chasing a dividend. So you've lost more than what the dividend yield returns, and that's not really a great investment thesis, right? So now you're talking about a stock that has rallied from its low back to its 50-month moving average. So now we're talking about a 4-year moving average at this point, and that's been big resistance really over the last several years. So this would be a good spot to either take some profits out of it, reduce the position weighting, wait for a correction back towards wherever it finds a new bottom, or sell the position and move on. If you're underwater, even with your dividends on a total return basis, maybe it's time to just move away from this and go put your money to work somewhere else. So look, it's always a challenge. This is one of the factors that people get trapped into all the time. It's like, I love the company, but it's just not working. But it has a dividend, right? So I'm getting the dividend, but the stock just keeps going down in price. And so they're psychologically trapped into the position of saying, I don't want to sell it because I don't want to admit I've got to take a loss, right? Or that it was a bad investment. I don't want to do that. So I make up all these excuses. Well, it's the dividend, it's the fundamentals, whatever it is. This has been a big long-term underperformer. There's other companies out there, even in the same space, that are potentially better opportunities. You could take a look at Verizon as an example. It's having the same type of structural problem that AT&T is. You could take a look at Comcast Communications, which is also in that same space. Very different picture. So if I was if I was in AT&T and I want communications, maybe I talk about swapping from AT&T to Comcast as an example. Trend is better. I have at least a positive bias to it. Yes, I don't get the dividend yield that I was getting in AT&T, but I also have capital growing, which is at the end of the day is our goal. Anyway, T1, I hope that helped you, but this is always the challenge that we all face in managing portfolios is when to let a dog go because it's actually a dog and not just a fundamentally cheap stock.
Well, TS also asked, so AT&T pays good dividends. How can we tell if the dividends will continue to be paid?
Right.
So obviously looking at free cash flow, looking at
Yeah.
other aspects of what they have going on the balance sheet, but they've historically been a good dividend payer.
Absolutely.
But I can tell you, we're going to get into a recession, and you're going to hear all these talking heads say, just buy a dividend portfolio. We're looking at companies that always raise their dividend in a recession.
Right.
But tell everybody what that really means.
Yeah. Well,
they're not raising their dividend. The percentage is going up based on a percentage based on the stock price. So stock price is going down. They just may not be cutting the dividend.
Well, and that's a big fact is that if you take a look at dividend payments in 2000 during the dot-com crash, and then also in the financial crisis in 2008, dividends were cut by more than 50% in both instances. And what that means is that you're looking at total dividends paid out by all S&P 500 companies. Those dropped by 50%. Now, those weren't companies just cutting their dividend from $1 to 50 cents. What happened is that there was a big swath of companies that basically eliminated their dividend entirely. Citigroup, Bank of America, a variety of others during the financial crisis. It's like, oh, yeah, I own this company for the dividend. That's great. Now you're down 50% in the stock, and now there's no dividend because they cut it. And that's what's going to happen during a recession because companies have to protect their profitability. And so they say, well, we're going to suspend our dividend for the time being. And so now you've got a stock that's down 50% and no dividend. But again, to Danny's point, how do you know what companies like that are at risk? Pay attention to free cash flow, pay attention to book values, pay attention to cash on the books. Do they have enough cash on their books to actually continue to pay their dividend in a market downturn, right? Can they pay their dividend for a year based on the cash they're holding? So for instance, Apple, absolutely, right? $150 billion in cash, whatever it is. Berkshire Hathaway, $150, $180 billion in cash. They can pay their dividend, no problem. So you wouldn't expect a dividend cut from a Berkshire Hathaway. You might see a dividend cut in, a company like Comcast or a company like AT&T if revenue flows get bad enough for the company.
Well, I think that's a big part of looking at fundamentals, understanding that aspect of it, because we do historically we like dividend paying companies because they're better stewards of capital.
Absolutely.
But you've got to understand the fundamentals and how to look at the balance sheet, and that's going to be where I think so many people have, and I'm not saying you guys, but I think a lot of people have forgotten how to understand fundamentals because they haven't meant anything. And if you're just basically buying on trends, or a lot of people don't even buy stocks anymore, they're just buying the ETF.
Yeah.
And so I think that we're going to get into some volatility that I think that'll provide a nice feather in your cap if you can understand what to look for.
Yeah, absolutely. So anyway, that's a great question. And again, I appreciate it because, this is something that, Mike and I struggle with. It's something that, you struggle with as always. And we always kind of get trapped. And look, it's happened to me before. We get trapped into a position. Love this company, man. Fundamentally, it's great, and it just won't work and I can, CVS was a good example. We've bought and sold CVS Health a couple of times because it's fundamentally a very sound company. Trade cash, plenty of cash, good dividend, trades at a price to sales of like 0.2. Company just won't work for whatever reason, and we've lost money on it twice now, so we're out of it for a while. Eventually, it'll come back. And generally, when we give up on it entirely, that's when it rallies. But it happens to all of us, right? We all make investment mistakes. We just have to own up to it, realize it's a mistake, and then move on.
Make small mistakes,
exactly.
Not big ones.
Yeah, absolutely. All right, Danny, thanks so much. All right, appreciate y'all joining the show today. We'll be back tomorrow on Thursday with Michael Leibowitz. Mike and I have a lot to catch up on after the last couple of weeks. So tune in tomorrow, Real Investment Show. Be sure and like and subscribe to our channel. We need your help, support, keep growing the channel, get those videos out there for us. We really do appreciate it very much. RealInvestmentAdvice.com. We'll see you back here tomorrow.